So we've covered many types of buying patterns now over the past several lessons, and I could really understand if you're overwhelmed. I mean, this took me almost 20 years of testing and trying and reading and working out to really have it all concrete in my mind. So I think the best thing is you can run checklists. I really recommend that you look at a lot of past stocks to see how these would have worked. The more you look at examples or look for these examples, the more your eye is going to train itself to spotting them. I mean, for myself, it's very quick to see them. They just kind of pop out at me, but I can completely understand if that's not the case with you. And if you just find there's just so many and it's really overwhelming, the reason I broke down all of these short-term tactical patterns into different categories is that really, if you want, you can use one or two patterns per category. So you have, most of your bases covered depending on market dynamics, and you can adapt, but you won't be overwhelmed at first. And as you become comfortable, you can add additional patterns and even some of your own if you feel that it's something that you're used to working with and you can identify what category it goes into. I mean, why not use something that is effective that you're used to? But I think it's best that now we bring it all together, and I want to show you how these shaper patterns really interact with all of these tactical patterns. You're going to see all these patterns show up as a shaper takes hold and breaks out. And this is going to be really a key thing in the future where this is really going to help with position building. And it's going to allow us to have small positions when we're wrong and really big positions when we're right, which is just a key aspect of successful investing. But for now, let's grasp on how to judge proper entries and how to put all of this together, and you're going to see it's going to start to make a lot more sense and really speak to you. So here we're taking a look back at booking.com, which we looked at earlier in the course when we first learned how all the different important elements of a shaper pattern come together to form these fantastic bases to begin looking for tactical patterns. And again, BKNG had all of these really key elements: the volume surges, the prior uptrend, the properly sized cup with handle, relative strength showing new highs before the S&P does. We had diminishing volume as the base progressed. And one thing that's really important again is all of these tight patterns. Again, a tight week or a tight pattern is when the week-to-week change is 1.5% or less. So basically, week to week, there's not a lot of variation in closing price. Regardless of what happens during the week, big funds bring it right back to the same level they've been buying at for the week before. So this is the chart we looked at earlier in the course. Let's take a look at how we can now look at this with all of our newfound knowledge about tactical patterns and how we can incorporate those to provide additional entries and great low-risk entry points. So this is that same cup and handle that we saw on the weekly chart zoomed into the daily chart. So what's really interesting and what I really enjoy about having all of these different tactical patterns is you never really know which ones are going to show up at which point, and it's really a matter of adapting to market conditions. So you can see here, booking.com, which at the time was priceline.com, had a big gap up here based on earnings. And that really completely changed the trajectory the stock was on from prior to the earnings report. Here it was kind of lethargic in a downtrend and just kind of disinterest by investors. And that earnings report really jolted things higher. So if this is a stock that was on your radar because they had some great earnings, great sales growth, they had that prior uptrend, you're watching and you're not really seeing anything form, you're below your 50-day and there's not a lot of interesting action, and then suddenly bang, you got this big buyable gap up off of an earnings report within this shaper base. And so even if you didn't see the rest of this chart, you would see this left side of this base forming and then suddenly this great big gap up through the 50. And that really is two patterns in one. It's the buyable gap up and the 50-day moving average volume breakout. So there's really two reasons to get in there. And for now, we're not going to focus on exit points and all of the position sizing, etc. We're really going to take a look at how to bring all of these patterns together. And so maybe you wouldn't have bought all of these different patterns, but these are all the different kind of setups that did occur at different times. So you had this great buyable gap up. Then if you weren't buying on the actual gap, you had a quick little pullback to the 8 exponential moving average for that gap pullback. And then we launched higher into new highs. And as that handle started to form, we kind of came down a little bit hard here. Maybe there was some news and the volume did pick up, but we solidified ourselves and we stayed above where we would have had an average cost basis on the gap up area. And we gapped up once again on the right side. I don't remember, this is going back to 2006, so I don't remember what the exact catalyst was. But again, that doesn't totally matter in this sense because, the volume was there and this was enormous volume and it was not earnings driven. So there was something very company specific. And that really got you a second buyable gap to buy. And again, when you're within the shaper base or within 10% of the highs, these big gap ups are buyable because you have that foundation of that base behind you. And so it's a breakaway gap and it's not a gap that is signaling the end of a trend, but rather the start of a trend. And lastly, after this buyable gap up, even if you were uncertain to buy in the open, you broke above your handle, and that cup and handle buy point is another legitimate buy point. You have these tactical patterns, but you also have your original shaper pattern buy points. So we're going to discuss later on how you want to position size with all of these different buy points. But as you can see, if you're looking at a stock undergoing accumulation, these entries will just show up on their own because these are just the footprints of institutions accumulating a stock. And after we had that very strong breakaway move, that expansion phase out of the base, that first touch of the 10-week line, which is this light blue line, occurred right here, and that gave you another great place to add to your winning position. And so you can see, whereas you would have had usually only one buy point out of this cup and handle base, here you had at least 5 different buy points. So it adds a lot of flexibility, and it allows you to really keep your risk low but not miss out on these huge advancers. This here is that NVIDIA chart we looked at earlier in the course, where we were really pointing out the relative strength importance and how you like to look at 2 different points in time to compare relative strength. Again, you can see here at points A and B, the market made lower lows, but NVIDIA made much higher lows. Again, here between points C and D, the market made lower lows and NVIDIA made much higher lows, and the same happened later on in the trend. And that's just really a recipe for success. That shows you that institutions are using any weakness in the market to really buy up the stock. However, you really want to keep that risk low. So how are we going to look at this big picture and have this great cup with handle forming with this company that has this great innovative technology, and you see that accumulation with the relative strength? How are we going to time our entries to really get in there and maximize our return versus our risk? So let's take a look at those tactical patterns. Similar to Booking.com, you had kind of that lethargic downward move on the left side of that cup with handle base, and earnings really got this moving again with this nice buyable gap up on the right side of the base. Again, this was a 2-for-1, almost identical to Booking.com, where you had that buyable gap up and you had that 50-day moving average volume breakout. You can see the volume really surged and was above average when that happened. And in this case here, there weren't a ton of buy signals that came up within the base. You had that buy signal there, and then your second one was your cup with handle. But you can see you could have added relatively quickly with a doji flag that occurred out of the base. Again, as you expanded out, you had that little doji pause day after the breakout, and when we gapped higher, which was also a kicker, but it really was a doji flag kicker, I guess a 2-in-1 there as well, that really signaled that there was additional buying going on in the stock, and you could have added with that volume coming in on that third day of that doji flag pattern. As the pattern progressed, we had our first test of the 10-week moving average, where you could have bought right at another great low-risk entry point. And once again, earnings came in and we gapped up off of that 10-week average. You're still in buyable range because you're within about 10% of that 10-week average basing area, and you could have bought your buyable gap up. And once again, you had another doji flag as the trend was really accelerating. So you can see there were multiple ways to enter this stock, and really it was a great way to get in with a low risk and ride that huge uptrend that then occurred in the stock over the following months. Here is Netflix back in 2010. Again, this is the double bottom base that was one of my first winners. I'll never forget the $124.10 buy point. Some of those things just stick in your mind. But we had all of those great characteristics that show up in these gray shaper patterns. Your prior uptrend, only a 25% deep base. It was 7 weeks in length. It was only a 1.5 times the market correction. Great volume spikes on the right side. All of the shaper characteristics were there, showing that there were the footprints of institutions were alive and well in the stock as it was basing with the market essentially. Here we shift down now to see how we could have really added to the double bottom buy point to have found other entry points. Now, to be honest, I wish I would have had all these buy points when I bought it back in 2010. I was using just the traditional double bottom at that point. But you can really see there were a lot of key entry points that showed up. First of all, we had a break of the prior low, and you had your shakeout plus 10%. And this, amazingly, this bar here, this candle on this day, triggered 3 different buy points. You had your shakeout plus 10%. You had your 50-day moving average volume breakout. So again, great volume on that breakout day. And we had the 50-day moving average bad break failure. So we broke hard on the 50-day here on really big volume, and that really failed to have any further progress, and we broke higher on great volume. So that really triggered 3 different rules. So you definitely should have been aware that the stock was doing something special here. We then broke out of the double bottom base, and after what we had was really interesting here, we broke the highs, and we had that failed breakout 20-day moving average pullback. So once you break the highs, if there's very little progress, when you snap back to that 20-day, That's often that great place to pick up some stock where everyone else is typically shaken out. As we based here right along the top of the double bottom, we had a great buyable gap up off of the 10-week moving average. We accelerated higher, and really we had our first touch of the 10-week that was outside of the basing structure, which provided an additional buy point. So again, whereas you would have had traditionally only that one buy point at the double bottom base, you had 5 different buy points within a 3-month span. So there's really no reason why you couldn't have had any position in what turned out to be a great final leg up in Netflix in 2010 into 2011.